Hello and welcome to this fifth episode of Your Next Trade. Today we're going to be talking about September sadness. Please read the disclaimers at the bottom of this page before doing anything. So September sadness. September was horrible, brutal for most asset classes. Stocks down, bonds down, so your 60-40 portfolio has been really suffering, and we closed yesterday in the US at the lows. True for the Nasdaq and for the S&P. So let's look quickly at how those different assets performed in September. In light blue on the left hand side we get indexes. So the only one standing is actually the Bovespa in Brazil. So we got the election, the first round tomorrow, where Lula is expected not to win, but maybe at the end of the month. So now question on that side is for Brazil at least is how much is priced in. The rest of the developed market and emerging market is more or less the same picture. We are down 10%. So 9.3% on the S&P, 10.5% on the Nasdaq. So very ugly month, brutal month. In terms of FX, so we got the US dollar, which is the king dollar. It has been true for the start of the year, and it's been true in September, which is up on the month, up versus most currencies between 2 to 5%, 8% even. Crypto down. If you do a risk off, despite what people were saying to you since 2015 about crypto, that there will be a good hedge against inflation, that they will be doing fine when the rest of the world is doing crap. Guess what? The crypto have been really struggling. Even more interesting, something that we covered a couple of weeks ago, which is about the Ethereum. Ethereum, since the big merge that they had, is down 15% in September. So pretty bad month. In terms of commodities, same picture, down. Why? Because now we are expecting the world to be slowing, going potentially into recession. So that means less commodities needed. On the September industries performance, picture is the same, with the US dollar on the right hand side doing very well. Interesting as well. So finally a bit of silver, gold miners who have been doing the job in the risk off / inflation. On the other end of the spectrum, so in yellow you get the S&P. Here you can see that many industries underperform, but actually it's 50-50 between the one that underperformed and the one that outperformed, but pretty nasty big picture with telco down almost 15%. Why telco down so much? Because you do have like a lot of stocks in this industry that are extremely leveraged. We are talking Charter Communication, Altis, those names, where actually if you look at the market cap, you will think, oh, actually this is small. And then if you switch into the enterprise value, which takes into account the debt, the size is just huge. And now I get the question with the yields going higher. The cost of debt is obviously rising, and the business model that you could have done when there was no inflation and when yields were very low is completely changing. So those business models are under pressure and that have been challenged. The rates going into the yields, we look at always at the different yields across the world. So we look at the 10 years. So the week to date here, this is not for the monthly, going actually a bit up. We've seen a peak in the US 10 years. So we peaked at 4% and we have been coming down. What is interesting is since the August, we have been up literally 130 points from 2.5% on 3.8%. So a bit of slowdown and actually a reversion that we have started to see since the Bank of England intervention around the midweek, which has helped bonds, or at least stopping the sell-off in bonds. You keep in mind as well something that we mentioned last Saturday, that at the end of the month, at the end of the quarter, you very often have the rebalancing from the mutual funds. So as the bonds were down massively over the months and the quarter, what we have seen over the last 5 sessions of the month is some rebalancing with those big funds buying some of the bonds again. So that has been helping the US 10 years going from 4% to 3.8%, 3.83%, at the close of yesterday. In terms of steepening, flattening, inversion of the yield curve, as I told you 3 weeks ago, there was some hopes that the Fed could be pivoting, that actually we could see a steepening of the yield curve. And I said to you, it's very early. It seems very that it's way too early. And actually, the steepening is not happening. And we are back to the 45 bips difference. So this is the 10 between the two. So we are inverted, which normally historically gives you a good tell that we are going into recession pretty soon. Euro dollar, I think this is one that is very interesting. So we are still expecting the terminal rate around the March. Okay, so this is the bottom of the expectation, which stands around 4.5 or 4.7% for the Fed, and then this is where the US 10 years have been trending. But if you look at the last, which is as of yesterday versus last week, we are seeing a less hawkish expectations from the market. So in a sense, that should be seen as a positive for stocks, where actually we expect the Fed to be less aggressive in hiking rates. Having said that, we are facing now new problems, and those things that we're going to cover just later. So the VIX now is around 31.6%. So above the 30%, there is an inversion of the VIX future term structure. The VIX again should be now taken with a pinch of salt, because a few years ago it was really it was a better indicator, let's say, looking at these 30 days option and implied volatility, which has been very under pressure due to many investors, retail traders playing with 1 day, 1 week, 2 weeks options maturity. So the VIX is not as good as an indicator as used to be. And we need to be more and more looking at how the positioning has been on the 1 week, something that you can do, something that I mentioned in the straddle. If you look at the SPY, if you look at any stock, how those stocks have been expecting to move in 1 day, 1 week or 2 weeks. So let's look quickly now at the technical analysis. So technical analysis, the picture is starting with the S&P futures is the same. Since I mentioned, the break of this trend, we have been trending lower. If you do a weekly, if you do a monthly chart, obviously you'd be saying that we are now reaching, that we close on the lows. September, as you know, and as I covered at the end of August, is much of the time on average a bad month, and obviously this month has been, as I said, very brutal, down 10%. The picture is not really good. If you look at some support, you're going to have first around the 3400. And then really the big fight, the big level is unfortunately 700 points below, which gives you another 20% downside around the 2900. So I'm not saying we're going to be going there immediately, but for the time being, there is not much of a support. If you look at the NASDAQ, this is the same picture. You are still in the downtrend that we have seen since the highs. The Russell, actually, interestingly, has not been making new lows this week, which is a good indicator that actually S&P core, US core stocks have been doing better than companies that have exposure non-US. So if you want to have more exposure for companies that are selling into the US than are international, you'll be looking at the Russell versus the SPY. And as you see here, the Russell is testing support, but for the time being, nothing has been broken. DAX, which you can do the same with the stock 600, looking and broke the support. On technically looks pretty bad. For those of you who are trading in Europe, you should be looking at the stock 600, the banking one, which is now very close to an important level. So this one should be on the top of your watch list if you are looking at Europe. Emerging market, as I said before and again, that was the one really to monitor, and that was your next trade. Why? For two reasons. With yields going higher, And with the weak dollar, it was clear that this one will have been under pressure. We broke some important level and we are potentially going lower. XRT, which stands for the ETF for retail. So this one broke a very important level as of yesterday. So this one, again, you look at the members and that tells you, in other words, that we switch from only the rate scare and everything to really US economy going into the recession. If you have done the 4x4 or if you've been a Mentees, you know that the US economy is 70 to 80% dependent on the US consumer. So that is making really almost 2/3 to plus of the US economy. When the retail XRT is breaking those important levels, that tells you that we are switching from a risk-off market to actually earnings scares, US recession coming, and US retail struggling. To come back on some of the ideas that I pushed last week, I was telling you one of the keys to do these days for your next trade is to be looking at what have been the winners and what have been the losers. So what you want to be long is obviously stocks that are outperforming the market. And we look at Home Depot. So I flagged Home Depot and I flagged Eli Lilly. So if you look at Home Depot versus the S&P for the week actually has been doing very well. Up 5 to 6%, and that's true as well for Eli Lilly, which gapped up on the Biogen news. But that tells you again, where is your next trade? It doesn't really matter to be looking at charts and saying, what has been happening in the past. What we want to know is with the price action, picking those stocks. So I'm very happy for those stocks that behave very nicely this week, and hopefully that's going to give you some good ideas in the future. Euro dollar. So euro dollar, the trend is still the same. So we tested the low part of this trend. Now we are halfway. So as a trader, if you are looking at currencies, if you are looking at euro dollar, you are in the middle of this range. So your upside downside is 50-50. So not that interesting. But really this trend that started at the start of this year has been working very well. So on the community, I had many questions at the start of the week, 4 days ago, and I said the risk reward was to go long the euro. That worked pretty well. US dollar yen. So guess where the Bank of Japan is standing? So if you look at this chart, it's not only that the chart is telling you that it's 145, but we know that here the Bank of Japan intervened, and the market is really keen on testing it again to see if the Bank of Japan will gonna be doing intervention again. Here we are looking at the renminbi. Again, this is your next trade, something that I flagged on the community. The 720 is a big level. And guess what? Over the last 3 days, Bank of China have been saying clearly that they want the banks to be keen, or actually to be ready, stand to do something and have the reserves exposed to defend the Chinese yuan. More importantly, October is going to be a big week, it's going to be a big month, for China, where we're going to have the Politburo and we are expecting many decisions to come. CL1 stands for WTI, still trending down. So you see the trend that is coming lower. We got a big OPEC meeting this week, very important because demand due to recession is probably going to go lower. Now there are talks between OPEC / Russia that they might cut production between 500,000 to 1 million barrels. And that is one of the things that we should be looking for this week going forward. Let's go back now to what happened this week. So this week, we had the bonds, the big moves in bonds. So at the bottom left here, we got the US Treasury versus the S&P futures since the beginning of August, and you see the correlation between the two. So each time we get the yields going higher, meaning the bonds going lower, we had the correlation and the S&P actually going lower. But as well, the correlation worked very well until Wednesday, Thursday, as long as we didn't have the Bank of England intervention. Once we had the Bank of England intervention, we had a bit of uncorrelation between the two, where actually the bonds did better, but stocks slash indexes, S&P, carried on moving lower. If you look at the US Treasury versus the dollar index, that is more or less the same, huge correlation between the two, with actually the DXY slash the US dollar, due to this risk off, has been really stronger than what it should have been. So there is a call here that not to be too surprised if the US dollar weakened by 2 to 3% over the next few weeks. Here we get the UK 30 years. So if you're living in the UK, if you've been anyhow working in the markets, you know that the yields from the 2 years to the 30 years in the UK has been under a lot of pressure. So here, to give you an indication, we are talking about the UK 30 years, which went from 3.5% yield to 5% yield. So that gives you 1.5% differential, literally over 3 days. Based on that, the Bank of England had to do some intervention. Why? Because pension funds are over leveraging the way they trade the market, and there was a lot of margin calls. And to balance those margin calls, the Bank of England had to intervene. So finally, what we had for the week, that's something that we mentioned looking at the calendar. That was yesterday, the PCE, looking at inflation. Unfortunately, here, this is not numbers that should be date, but you get the picture where there is a strong correlation due to the Fed mandate between the core PCE, which is what the Fed is mostly looking at, and not the CPI, and the Fed fund targets. So we should expect, again, the Fed fund targets to go lower. PCE, unfortunately, was higher than expectations, and that gave us the final leg yesterday on the market, moving on the S&P from 3670 to 3600. So why is your next trade? For the catalyst, so we get plenty of catalysts for this week. So first we start with the ISM manufacturing on Monday. Then we get the ISM services on Wednesday. Then we get the noise here from the Friday NFP. Actually, what you would like to see is a bad NFP number, which will be a confirmation that unemployment starts to go up, and that actually, hopefully, that inflation will start to come lower. OPEC meeting on Wednesday, so that gives you that Wednesday is going to be an important day. What is important to know is normally October, November, and December are good months in the market. So if you look here, this is the seasonality of the S&P. This is the one here. And if you look, we go 2.7% in October, 1.6% November, and 0.9% in December. So October is generally a very good month, but, and I think this is very important to remember that one, because I was already trading, obviously, in 2008, which is here. This is your year here. Is it the one? Yes. Yes, this is 2008. So in 2008, we got actually the September which was down 9%, which is more or less the same what we had in 2022. And in October, we went down 17%, then another 7% in November. So in terms of seasonality, where people are telling you, oh, this is good seasonality going forward, if you get the outlier, you're going to be down 25%. And guess what? 25%, you go from 3,600 to 2,900, and this is one of the targets that I have. So be extremely careful. Finally, in terms of catalyst, not this week, but the week after, starting roughly with JP Morgan on Friday in 2 weeks' time, we got the earnings season starting. So this is really the next big catalyst. Now the market is really looking forward into the earnings for this quarter. What are the expectations going into next year? If you look at the numbers that we have for this week, so we got Micron, we got Nike. So Nike yesterday got absolutely hammered, 10% on many drivers that we had in the past. First, too much inventories. Secondly, the margins coming down, plus China. In terms of margins, this is something that I flagged since January of this year. When operating margins are 13-15%, our all-time high, there's a good chance that they will go lower, and that is what has been happening. So based on that, many Analysts have been lowering the expectation over the last 3 months for the S&P for this quarter, minus 6.6% for the quarter, which is way above average. But that tells you that actually we could have some nasty numbers coming for this quarter. And for this quarter, that is true, again, if you look at Nike, if you look at Micron, if you look at many companies, CarMax that went down 15%. So a picture is pretty ugly. That doesn't mean that you don't have winners. As I said before, if you look at Home Depot, Eli Lilly, there are some good trades that you can do. Finally, for those of you who have done the 4x4 / the mentoring and are more advanced in your research, you know that special situation is a place to be making money. So Thursday this week we got the IPO in Europe of Porsche, which was a good trade to do. Now, on Monday, we got the ABB spin-off. So ABB, which is dual listing both in Switzerland and in the US, will be spinning off one of its business. So as always, be looking at those special situations. When you are struggling to keep that many positions due to volatility, the best place to be making money is obviously to be looking at special situation where you get natural drivers. Okay, so I'm doing a lot of those these days, and actually that avoids to be caught in the noise or the big moves of the market. So if you are looking for more information of what I've discussed today, in this video, you can be looking at the 4x4 video series or the mentoring. If you get questions, obviously send me an email. You can join the trading community. This is a free trading community on Discord. So we are almost, I think, 150 people now with more and more activity. So please feel free to join. And if you like what you're seeing today, please subscribe to the video. And we're going to be meeting next week for the next catalyst, which is going to be the earnings season. So have a good start of the quarter, of the month. Be careful with seasonality and look for special situation where you're going to have natural drivers. All the best. Bye-bye.